The Standard Bank Youth Barometer report reveals a generation of youth who demonstrate resilience and resourcefulness. This is despite the high cost of living, debt exposure, and economic uncertainty. The report finds that they are pragmatic decision makers, conscious of their limits. Across all youth segments, a greater share of spending is allocated to essential items over discretionary ones. In the age groups of 18 to 24 years, the report finds that this group allocates 58% of their spend to essentials. They spend proportionately more on clothing, groceries, dining out, entertainment, digital and connectivity, and fitness and self-care, prioritizing spending on experiences. For the age group between 25 to 29 years old, the focus on insurance and loan repayments begins to rise, indicating a growing financial stability. The report says the age group is in its image investment era, refining personal brand through curated spending on fashion and lifestyle. For those aged between 30 and 35 years, the report says they spend a smaller share on groceries, clothing, digital connectivity, but a bigger proportion on insurance, loans, and healthcare.
When we think about our youth days, you could think about, lavish spending. But certainly when we look at what the 18 to 24 spend on, their top categories include groceries, restaurant and fast foods, certainly digital and connectivity, clothing. We do see really responsible categories like education and savings coming up. This makes sense for us with regard to education, because this does tend to be the time in youth life where they are investing in education. They're still in tertiary institutions, if they're fortunate enough to be in those. And so there is definitely spending going towards education. The idea of it being experience-driven is we do observe that this age bracket does tend to spend a higher proportion on entertainment, on restaurants and fast foods and clothing. And when they do spend or splurge on clothing brands, which isn't extensive or often because their income is quite limited, we do see the prevalence of luxury brands coming out more prominently in the 18 to 24s than in the other youth age brackets.
The report further finds that young South Africans that it surveyed are engaging with credit more cautiously and selectively than older generations. They generally hold fewer credit cards, make smaller purchases, and repay more frequently. It also found that the buy now, pay later usage among those under the age of 35 nearly doubled from 102 million in 2023 to 200 million in 2024, reflecting their preference for flexible digital-first credit solutions.
Buy now, pay later is actually becoming quite popular, and for this sort of customer base, compared to actually any other segment that we have within the credit card base, this is actually where you see the biggest usage of buy now, pay later. Probably talks to the same sort of constraints that the customer, that Shanae spoke to as far as the customer profile is concerned, and obviously the disposable cash that they have. But this also can also talk to availability of credit at times, because buy now, pay later you can run on both your credit as well as your debit card products, and you also get, if you you stick to sort of the terms and conditions that you get from the service providers, get that 0% sort of free interest on the product. But in the last couple of years, you do see that there's been quite significant growth on the buy now, pay later space. And the likes of Payflex and Payjust now probably being the dominant service providers that we're sort of seeing in the market. And this is a trend that you potentially expect to continue, given that it's almost cheap credit, if you want to call it that, for most of this customer base.
Youth under 35 years old represent a strong and growing interest in property ownership, making up around 40% of all new home loan inquiries at Standard Bank.
Overall, we're seeing a bit of an increase coming through from the under 35s in terms of the new home loans. And we suspect that in terms of last year's numbers specifically, we believe that this is as a result of the interest rate cycles that we saw coming through. And with some of the interest rates starting to kind of settle in this year, we're starting that uptake coming through. So in terms of, if you look at the home loans that has been granted, I think the key intake here is that The average home loans that we're starting to see for this particular age group is sitting around kind of your 1.2 million on average. And again, this is no surprise in terms of, if you compare that in terms of what we're seeing also in the market.
At the same time, across the board, the bank says the youth constitute 37.7% of their vehicle finance customer base. It says while 65.1% of youth finance cars without deposit, but the high installment to income ratio for youth shows that they are stretching their budgets to afford cars. The report encourages starting small, tracking spending and setting limits. It actively encourages early and consistent saving habits by framing saving as a strategy for peace of mind due to financial security and not a sacrifice. Diabosito, SABC News, Johannesburg.